Welcome to the Deep Dive. Today we are pulling apart a fascinating investment memo focused on BlackRock Inc., BLK, the company that manages more money than anyone else on the planet.
That's right. This memo, it's from June 14th, 2025, and it performs what it calls an enduring quality analysis of BlackRock, essentially asking, is this a business built to last, and maybe is it a good candidate for a long-term investment?
And our mission today is to take you inside that analysis. We're going to unpack how BlackRock actually makes its money, understand the incredible strengths that make its business model so, durable. We'll look at the people running the show, check the financials, and really wrestle with the key risks and opportunities this giant faces.
Yeah, we want to help you see why this model is considered so resilient and, importantly, what this specific analysis suggests the market might be missing about where BlackRock is heading next.
Okay, let's unpack this then. Let's start right at the core. BlackRock's business structure. What is it, fundamentally?
Well, the analysis highlights this right away. BlackRock is an agent. They are managing other people's money. That's key. As a fiduciary.
Okay.
And crucially, they aren't primarily using their own balance sheet for, say, principal trading like a traditional bank might.
So that structure kind of insulates them from certain financial risks?
Exactly. It provides inherent insulation.
So their stability isn't really tied to taking huge risks with their own money. Makes sense.
Yeah.
And how does managing, over $11.5 trillion, assets under management, AUM, how does that turn up the revenue?
It's actually pretty straightforward, and the beauty is just how scalable it is. The vast majority, nearly 79% back in 2024, comes from asset-based fees.
Right.
Think investment advisory fees, administration fees, securities lending revenue. It's all calculated as a percentage, usually a tiny percentage, of that massive AUM base.
So $16.1 billion in 2024 from that.
Yep. So even if the fee rate is just basis points, fractions of a percent.
Multiplied by $11.5 trillion.
Oh, exactly. That's your core engine. As that ocean of capital grows globally, their revenue tends to grow too, almost like clockwork.
Right, kind of on autopilot.
But there's another piece, strategically important, that's growing faster. Technology services.
Aladdin. Everyone talks about Aladdin.
That's the one. That's the core of it. In Q1 2025, tech services brought in $436 million, about 8.3% of revenue.
Smaller slice, but strategic.
Very strategic. The analysis really emphasizes its significance and, importantly, its growth potential.
Any other notable revenue streams we should know about?
Yeah, you've got distribution fees. That was around 6% in Q1 2025, basically for getting their products out there through different channels.
Right.
And then smaller amounts, maybe 1 to 3% typically, from performance fees. That's based on hitting certain investment benchmarks in specific funds.
Got it. So asset-based fees are the bedrock. Tech is the high-growth strategic layer. And product-wise, they seem to offer something for, everyone.
A truly comprehensive suite. Equities, fixed income, alternatives, cash management, all delivered through vehicles you probably recognize, like their iShares ETFs,
right?
Traditional mutual funds, and also customized separate accounts for, huge institutional clients.
The memo uses a great analogy for this. It calls BlackRock a global toll collector on the ever-expanding ocean of capital. That really paints a picture, doesn't it? Simplicity, endurance, tied directly to global wealth growing over time.
It really does. And the analysis points to 2 really powerful structural forces that anchor this endurance. The first one, the retirement imperative.
You mean the big demographic shifts we're all seeing? Aging populations, people living longer, that whole shift from company pensions to individual responsibility like 401ks and IRAs.
That's exactly it. The burden of saving for retirement is increasingly falling on individuals. And this creates this massive multi-decade demand for investment products. BlackRock's stated purpose, helping people achieve financial well-being, it aligns perfectly with this fundamental societal need.
And the second big force fueling their growth.
The passive investing revolution, that massive shift away from typically higher cost active managers towards low cost index funds and ETFs.
Because most active managers just don't consistently beat the market after you factor in their fees, right?
Pretty much, yeah. It's tough. And BlackRock's acquisition of iShares back in 2009, that was a masterstroke. It put them right at the absolute center of this huge trend.
And iShares is now the world's biggest ETF provider. Something like 1,300 products.
That's right. So you have these 2 huge tailwinds massive structural demand from demographics, and this big preference shift towards the exact kind of low-cost, accessible products that BlackRock dominates.
Which creates that virtuous cycle the memo talks about.
Exactly. Economy and markets grow, AUM grows, their fee revenue grows. It's a high-margin, capital-light way to basically invest in and compound alongside global capitalism itself.
Sounds incredibly stable. So how does the memo describe the defenses around this business, its economic moat?
It calls the moat wide and deep, multi-layered.
Yeah.
Strong enough to justify that wide moat rating you see from firms like Morningstar.
Okay.
And the analysis really highlights two layers as being particularly formidable: intangible assets and cost advantages from scale.
Intangible assets first. I imagine the iShares brand is crucial there.
Oh, it's huge. The memo says it's basically globally synonymous with ETFs. For millions of advisors and investors, it's the default choice. Why? Because of the trust, the quality, the accessibility they've built up over, 2 decades now?
Yeah.
It points to things like having over 550 Morningstar Gold or Silver ratings for iShares funds. That's double their nearest competitor.
That kind of brand recognition is incredibly hard and expensive to replicate. And the other intangible, Aladdin. You called it strategically important earlier. The memo says central nervous system.
It really is. It's much more than just software. It's the core platform for end-to-end portfolio management, trading, risk analytics, not just for BlackRock's own use, but they license it out to hundreds of other major financial institutions too. Licensing it to competitors. Sounds a bit counterintuitive, maybe.
Well, it creates these massive switching costs, you see, and network effects. Once a big institution is running its core operations, its risk management, its trading through Aladdin, ripping that out is incredibly difficult and expensive.
Right.
And the more firms that use it, the more it becomes the industry standard, which just reinforces its value and makes it even stickier.
So dominant brand, indispensable tech platform. That's the intangible side. What about the cost advantages from scale?
This is where that sheer size, the $11.5 trillion plus in AUM, becomes a competitive weapon. That colossal asset base lets them spread their significant fixed costs. Things like developing and maintaining Aladdin, regulatory compliance, research, across an absolutely enormous revenue pool.
Giving them operational leverage that smaller players just can't dream of.
Exactly. And this translates directly into a sustainable cost advantage. They can offer just razor-thin expense ratios on core products like the iShares Core ETFs that smaller competitors simply can't match profitably.
And those low costs attract more assets, which further enhances their scale, which allows them to lower costs or invest more. It just reinforces that virtuous cycle. Scale breeds cost advantage, which breeds more scale.
It's a really powerful loop. The memo gives a practical example for you, the listener. Imagine you're a financial advisor building a diversified portfolio for a client.
Right. You need exposure to U.S. stocks, international stocks, bonds. The analysis notes that the default choice often goes straight to iShares. Maybe IVV for the S&P 500, IXUS for international, AGG for bonds.
Why iShares?
Well, it's the combination. The brand is trusted. The product breadth is just unmatched. Needs some niche sector or factor. iShares probably has an ETF for it. The liquidity is immense because of the scale, which means tight bid-ask spreads when you trade. And, of course, the fees are among the lowest anywhere.
It's the whole ecosystem.
It really is. A competitor can't just launch, say, one cheap S&P 500 ETF and expect to compete effectively against that whole package. They'd need to replicate the entire ecosystem, the brand trust, the breadth across all asset classes, the liquidity, and have the scale to offer competitive fees everywhere. That's an incredibly high barrier to entry.
So the moat is definitely wide. Is it getting wider? Does the analysis suggest that?
It argues strongly that, yes, it is actively widening. BlackRock continues to capture a disproportionate share of new money flowing into investments. They're part of the big three in U.S. ETFs, sure, but the memo notes their S&P 500 ETF, IVV, pulled in huge inflows in 2024 alongside Vanguard's VOO. While interestingly, State Street's SPY saw share decline, and their dominance in bond ETFs even more pronounced, according to the memo.
And they're not just resting on their laurels with public markets, right? They're making big strategic moves elsewhere.
Yes, a really significant and accelerating push into private markets. These are often less efficient, potentially higher margin areas. They're doing this through some pretty bold acquisitions.
Like the Global Infrastructure Partners deal, GIP, that was $12.5 billion.
Exactly. That positions them right in a fast-growing segment, infrastructure, which aligns perfectly with those mega forces Larry Fink often talks about, huge infrastructure needs globally. Then there's acquiring HPS Investment Partners, roughly $12 billion, which establishes a leading private credit franchise for them.
Okay. Those make sense buying asset managers in growing areas.
Yeah.
But what about the deal for Preqin? That was about $3.2 billion for a data provider. How does that fit?
The memo flags Preqin as potentially the most significant moat widening move of the recent batch. It's a pure data and technology play.
Okay.
The strategy, as the analysis lays it out, is to integrate Preqin's premier private markets data with Aladdin and with eFront. That's the private market software they bought back in 2019.
Creating a unified, like an operating system for the whole portfolio, handling both public and private assets together.
Exactly that. This directly tackles a major headache in private markets. The lack of transparency, the lack of standardized data. As more clients use this integrated platform, the data gets richer, the analytics get more powerful, and that Aladdin network effect we talked about gets even stronger, but now extends deep into private assets. It's really elevating BlackRock from just a product provider towards becoming indispensable infrastructure.
From indispensable product maker to indispensable utility. That's a big shift. The analysis suggests this integrated platform fundamentally increases client stickiness and those switching costs. And that 16% year-over-year growth in tech services revenue in Q1 2025, that seems to back up the strategy, is gaining traction.
It certainly seems to support it, yeah.
The analysis also included some Scuttlebutt simulation, trying to get ground-level views from customers and employees. What did that turn up?
Well, it largely seems to validate the strategic priorities we've been discussing. On the customer side, there's a clear split, a bifurcation in the service experience.
So products are generally loved, right? Low cost, diversification. Those Morningstar ratings confirm that.
Yes, the products themselves get high praise. But the service, the analysis suggests it's kind of tolerated, maybe even disliked, by retail investors and smaller clients. It cites things like subpar customer service, sometimes complex fee structures. It even mentions BlackRock exiting their direct robo-advisory business, Future Advisor, which apparently left some high-net-worth clients feeling a bit abandoned.
So for that segment, they're clearly not trying to compete on the relationship or advice side.
Seems not. The focus there looks squarely on being the efficient, low-cost product manufacturer. But, and this is crucial for their large institutional clients, the service is loved. This is described as a key competitive strength. BlackRock positions itself as a deeply integrated strategic partner, offering consultative support, sharing capital markets expertise, running educational programs. The memo mentions the Aladdin client services team, for instance, being heavily staffed with top talent specifically to provide that high-touch support that justifies the platform's high cost.
So what looks like a weakness in retail service is actually evidence of a deliberate strategic choice. They're focusing the expensive, high-touch resources on the huge institutional relationships that drive the AUM growth and really reinforce the moat.
That's how the analysis frames it, yes.
Okay. And what about the view from inside, the employee perspective?
Insights gathered from places like Wall Street Oasis suggest a largely positive view on the culture and work-life balance. You hear phrases like great place, amazing WOB, often cited around 40-50 hours a week, which is pretty good for finance. Generally nice people, a mission-driven environment. The analysis even notes that sometimes employees leave for higher pay elsewhere but end up returning, which speaks volumes about the quality of the internal environment.
Interesting. What about compensation and career path, though?
A bit more mixed there, it seems. Junior level pay is seen as competitive, but apparently it can lag behind competitors at more senior levels. And within active management, the culture is sometimes perceived as prioritizing marketing and asset gathering, maybe more than rewarding individual stock-picking brilliance or alpha generation. The overall sense is that the culture prioritizes platform stability and process over relying on and perhaps highly rewarding individual star performers.
And why do these ground-level views matter for the investment analysis? What's the takeaway?
Well, they seem to confirm BlackRock's strategic execution. Both the split in service levels and the employee culture point towards a firm that's deliberately allocating its resources to build and defend that moat, focusing the high-cost service on the institutions and building a stable, process-driven organization rather than relying on a few key individuals who could potentially leave and disrupt things. It reinforces that picture of long-term stability and strategic focus.
Okay, that gives us a really deep understanding of the business itself and its increasingly formidable moat. Let's turn to priority 2 in the memo. Management, stewardship, and financial resilience. Because you can have a great business model, but the people running it and the strength of the finances, that's critical for long-term success.
Absolutely critical. And the analysis starts right at the top with CEO Larry Fink. He's a co-founder, remember, from way back in 1988, CEO since 1998. That kind of tenure is extraordinary. It provides incredible stability and a clear long-term vision. He really seems to operate with an owner-operator mindset.
He's well known for focusing on those huge structural mega forces shaping the economy rather than getting caught up in short-term market noise.
Right. And he often frames BlackRock's role in terms of solving big societal problems, like the retirement challenge we talked about. He uses personal anecdotes like stories about his parents and his annual letters to illustrate why BlackRock's work matters in creating, as he puts it, a virtuous economic cycle.
So the vision is there. How does the analysis assess his actual track record on capital allocation? Is it disciplined? Rational?
It describes it as, frankly, a textbook example of rationality and discipline. The strategy seems very clear. First, prioritize reinvestment back into the business, specifically to widen that economic moat, and then return any excess capital to shareholders.
And since it's a capital-light business model...
Right. Reinvestment primarily happens through strategic value-adding acquisitions.
Which brings us back to those big deals we mentioned, GIP, Preqin, HPS.
Exactly. The analysis reiterates these weren't just random empire-beating moves. They're seen as bold, yes, but strategic and logically interconnected pieces, all building towards that whole portfolio platform and deepening their capabilities in private markets.
And what about returning cash to shareholders?
Very consistent, very substantial. They've got a remarkable track record, 16 consecutive years of dividend growth. The payout nearly doubled just between 2018 and 2024, from about $12 to over $20 per share.
Wow.
And they're also consistent and disciplined share repurchasers.
Like the $1.6 billion in buybacks in 2024, part of nearly $5 billion returned in total that year.
Yep. And they've shown they can be opportunistic, too, like when they bought back $1.1 billion of stock directly from PNC Bank back in 2020 when PNC sold its stake. They even used buybacks for their own closed-end funds when those funds trade at a discount to their net asset value, which is another sign of pretty smart capital allocation. The memo includes a summary table showing that even with significant M&A spending in 2024, around $15.7 billion, they still consistently return substantial cash to shareholders in the $4 to $5 billion range annually over the last 5 years.
So the overall conclusion on management is that their actions show a clear, rational logic. Reinvest to strengthen the fortress, return the excess cash, no real signs of value-destructive empire building.
That's the analysis is read, yes. The acquisitions appear strategically coherent, aimed squarely at future growth and enhancing that moat.
This financial discipline must underpin their financial fortress, then. How does the memo characterize their overall financial health?
It calls BlackRock an earnings machine. Remarkable profitability and consistency over the past decade. Just look at the numbers. Revenue grew from about $11.4 billion in 2015 to $20.4 billion in 2024.
Okay.
Net income more than doubled in that time, from $3.3 billion to $6.4 billion. And importantly, they remain strongly profitable even in tough market years, like the downturn in 2022.
That consistency is definitely a key sign of a high-quality business. What about specific financial quality ratios? Does the memo highlight any?
It does. It points to a return on invested capital, or ROIC. Basically, how efficiently are they using their capital to generate profits?
Right.
It's been consistently high, averaging about 10.9% over the last 5 years. For a company of this sheer size, consistently hitting double-digit ROIC. That's really a hallmark of an exceptional business with a powerful moat. The memo does add a nuance, though. It notes ROIC hasn't always consistently outpaced their estimated cost of capital, sometimes called WACC. That's the minimum return needed to actually create value. But it suggests the full impact of these recent large acquisitions will take time to flow through and potentially boost that further.
Makes sense. How about free cash flow? Are those accounting profits actually turning into cold, hard cash in the bank?
Yeah, pretty healthy free cash flow conversion. Based on the 2024 numbers, they converted about 74% of their reported net income into free cash flow.
And that's good for a financial firm.
It's pretty healthy, yeah. There are always differences due to non-cash accounting items, working capital swings, that kind of thing. But around 74% conversion is solid. Their free cash flow margin is also high, over 22%. Lots of cash generated relative to revenue.
And the balance sheet itself, debt levels?
A fortress.
No.
Really strong. Very low net debt. It was around $4.4 billion as of March 2025. Now compare that to their trailing 12 months EBITDA. That's a common measure of operating profit, which was over $8.2 billion. That gives you a net debt to EBITDA ratio of only about 0.53x. Extremely low leverage.
Wow.
That, combined with the capital-light nature of the business model, really speaks to prudent financial management.
So, okay, we've painted a picture of an exceptional business, wide and widening moat, disciplined management, backed by a financial fortress. Now for the crucial question, priority 3, price versus value. Is this high-quality business actually available at a reasonable price, according to this analysis?
Right. As of the memo's date, June 2025, the valuation was sitting at roughly 23.9 times price to earnings and around 38.2 times price to free cash flow.
And how does that stack up against its own history?
Well, it's trading at a premium. That PE of around 23.9x is about 9% higher than its average over the previous 5 years, which was 21.9x. And it's significantly above its 10-year historical average PE of 18.9x.
Okay, so definitely not cheap based on history. The market is clearly recognizing the quality we've been talking about and pricing it in. Does the analysis think this premium is justified? Is it still a good buy?
This is really the core judgment call in the memo, and the analysis concludes that yes, the premium is justified, and that the current price represents a fair, possibly even attractive entry point for a long-term investor.
Okay, tell me why. What's the reasoning behind that conclusion?
The analysis argues that while the market correctly sees BlackRock as a world-class asset manager, it might be underestimating the profound transformation that's happening right now. Meaning, this strategic pivot towards integrated financial technology and private markets isn't just about adding new product lines. It's fundamentally altering the business profile, making it potentially even more durable, stickier, and higher margin over the long run.
So the acquisitions, GIP, HPS, Preqin, they're not just additive, they're seen as synergistic, creating something bigger than the sum of the parts.
Absolutely. That's the argument. They're not just random grabs for new asset classes. They're viewed as pieces of a puzzle, building out that stickier, higher growth, potentially higher margin business. The market might see product line extensions. This analysis sees an indispensable, almost utility-like ecosystem being constructed. That central nervous system idea again.
Got it. So the logic is paying a modest historical premium is rational because you're buying a company that's actively transforming itself into something even more essential, even more moaty than it was before.
That's the crux of it. Paying up slightly for a company actively making itself more wonderful, as Buffett might say.
But what are the main risks to this optimistic outlook? What could derail this transformation?
Well, the analysis identifies some pretty significant risks, particularly those structural threats that could lead to, permanent capital impairment. Not just a bad year, but lasting damage. The primary growth engine, as envisioned, relies heavily on successfully building out and integrating this whole private markets and technology platform. Management has set some ambitious targets, like raising a cumulative $400 billion in private markets by 2030.
Wow.
And aiming for private markets and tech services combined to contribute over 30% of total revenue, which is up significantly from about 15% in 2024.
And that growth is supposed to be fueled by capturing that golden age of infrastructure with GIP, dominating private credit with HPS, and really enhancing the whole Aladdin ecosystem with the Preqin integration.
That's the plan. But the potential threats are very real. First and foremost, existential regulatory and political risk. BlackRock's sheer size, that $11.5 trillion plus AUM, it's their greatest strength, but it's also arguably their greatest vulnerability.
Being labeled a shadow bank, attracting intense scrutiny from regulators and politicians.
Exactly. There's the risk of being designated a CFI, a systemically important financial institution. That's like being declared too big to fail, and it comes with much stricter rules, higher capital requirements, more oversight. Right. Or even potentially antitrust action. Calls for a forced breakup aren't completely unheard of. The memo specifically points to the politically motivated backlash against certain investment principles, like ESG, coming from some U.S. states.
Mm-hmm.
It highlights that as a clear manifestation of this risk, showing how BlackRock's size and influence inevitably make it a political target. Now, the analysis isn't taking a side on ESG itself, just reporting that this dynamic exists and creates risk for BlackRock due to its prominence.
Understood. Impartially reporting the risk factor. What else?
The relentless pressure on fees. Irreversible fee compression is just a structural reality in asset management.
Especially in core ETFs.
Especially there. The risk is that this pressure accelerates, maybe spreads more aggressively into other areas, and potentially outpaces the higher fee growth they hope to get from private markets. That could structurally lower BlackRock's overall operating margin over time.
And with those huge, complex recent acquisitions, there's got to be M&A integration and execution risk, right?
Absolutely. Integrating the cultures, the technology platforms, the processes from multi-billion-dollar deals like GIP and HPS, that is incredibly challenging. Failure here wouldn't just mean the deals don't deliver the expected value. It could cause significant disruption, maybe even value destruction.
Yeah.
The analysis also mentions catastrophic reputational damage as a key risk. In a business built entirely on trust, like asset management, that could be permanently impairing. And as we already discussed, the demanding valuation itself means expectations are high. There's little safety margin if execution isn't pretty close to flawless.
Okay, so the general market consensus seems largely positive, right? High-quality company getting even better, hence the premium valuation. How does the second-level thinking in this particular memo differ from that consensus?
Well, the market consensus is overwhelmingly positive, as you say. Most analysts have buy or strong buy ratings. The narrative focuses on solid execution, the pivot to alternative assets bringing higher fees and growth. Basically, seeing a great asset manager improving its product mix.
But the contrarian angle in this analysis is that the consensus, while positive, is maybe too simplistic.
Exactly. It doesn't really dispute the positive direction, but it argues the market is significantly underestimating the true long-term value being created by this transformation.
How so?
The market sees these acquisitions and the tech growth primarily as product line extensions. This analysis sees them as something more fundamental, foundational building blocks of an integrated, nearly unassailable ecosystem. The real genius, the memo argues, isn't just buying GIP or Preqin, it's the integration. Knitting together Aladdin, eFront, and Preqin data that's widening the technology and data moat in a profound way the market might not be fully appreciating yet.
So by embedding this whole integrated stack deeper into client workflows, BlackRock moves from being perhaps a replaceable provider of great products towards being an essential, utility-like piece of the global investment infrastructure itself.
That's the core insight the memo believes is underestimated. The profound increase in client stickiness, those switching costs we talked about, the network effects from this integrated whole portfolio platform that warrants a higher and, crucially, a more durable valuation multiple. The consensus sees a better asset manager. This analysis sees the emergence of the central nervous system for the global investment industry.
That's a powerful framing. Okay, let's try to pull this all together now into the one-pager summary from the memo crystallizing the bull case and the bear case. Priority 4.
Right. The bull case, the core reasons to own BlackRock, according to this analysis. First, dominant and scalable business model. It's that highly profitable, capital-light toll road benefiting from structural growth in global capital, the retirement imperative, the passive shift.
Okay.
Second, widening competitive moat. Built on scale, the iShares brand, the Aladdin platform, and now being actively expanded through the push into private markets and that integrated technology platform, increasing stickiness and switching costs. Third, exceptional management and capital allocation. Led by the long-tenured founder Larry Fink, demonstrating a clear long-term vision, rational decision-making, reinvesting strategically to widen the moat, and returning substantial excess cash to shareholders. And fourth, a financial fortress. Just a consistent earnings machine with high returns on capital, strong free cash flow generation, and a pristine low-leverage balance sheet.
Okay, that's the bull case. Compelling. Now, the bear case, the counter thesis, what could realistically go wrong?
Well, number one is that existential regulatory risk. The sheer size, its strength is also a liability, attracting political scrutiny, the risk of sci-fi designation, potential antitrust action.
All right, the scale becomes a target.
Exactly. Second, margin erosion from fee compression. That relentless downward pressure, especially in core ETFs, could outpace the growth from higher fee alternatives and structurally compress margins over time.
Okay.
Third, M&A integration and execution risk. Just the significant challenges of successfully integrating these recent large, complex deals like GIP and HPS. Things could go wrong. And fourth, the demanding valuation itself. Trading at a premium means high expectations are already baked into the price, leaving very little margin for error if execution falters or growth disappoints.
And finally, the memo includes a red team challenge, deliberately trying to break the bull case. stress testing it by imagining a plausible scenario where it completely fails.
Yeah, this is where you really try to invert the optimistic view. Imagine a plausible scenario unfolding over the next decade. The big pivot into private markets basically fails. Maybe they bought the top right before macro factors like persistently high interest rates or a global slowdown really curtailed deal flow and compressed returns in private equity and infrastructure.
Ouch. So GLP and HPS end up looking like expensive blunders, maybe even requiring write-downs.
Could happen. And imagine at the same time, intense fee compression triggers a brutal price war in their core ETF business.
So the old engine sputters just as the new one fails to fire.
Exactly. The fee pressure outpaces any growth from alternatives, leading to stagnant, maybe even declining earnings, significantly missing the high expectations baked into that premium valuation. And then layer on top of that, political risk escalates dramatically. Maybe a populist administration comes in and specifically targets BlackRock's size, its influence, maybe citing the ESG controversies, and launches a sweeping antitrust investigation with a very real threat of forcing a breakup of the company.
And the outcome in that nightmare stress scenario.
Well, you paid that premium price for the wonderful company, just as its new growth engine completely sputtered, its reliable old engine faced unprecedented pressure, and its greatest strength, its sheer scale, became its Achilles heel, attracting potentially existential regulatory risk. The result wouldn't be compounding wealth. It could be years of stagnant returns, maybe even significant permanent capital impairment. It's the kind of scenario that keeps long-term investors up at night.
So we've taken a really deep dive into BlackRock today, guided by this fascinating investment memo. We've looked at its seemingly simple but incredibly enduring business model, its powerful and widening competitive moat,
The stewardship of its long-tenured leadership, its undeniable financial strength.
and also the potential risks and the truly transformative growth drivers it's pursuing right now.
And here's where it gets really interesting, I think. The core argument presented in this analysis is that the market, while definitely acknowledging BlackRock's quality, might be significantly underestimating the full impact of its transformation, moving from just being a great asset manager towards becoming an indispensable, almost utility-like infrastructure provider for the entire global investment industry.
Yeah, through that integration of technology, data, and private market capabilities.
That's right.
So this raises a really important question for you, the listener. Considering the incredible durability and the bold strategic moves BlackRock is making to potentially become even more essential, but also facing these very real threats, like significant regulatory pressure and that constant fee compression, how do you weigh the potential for continued dominance and this grand transformation against the risks outlined in that Red Team Challenge?
Yeah, what stands out to you as maybe the single most significant factor, the one thing that will really determine BlackRock's path, its success or failure over the next decade?
Definitely something to think about as you continue your own deep dives.